This year's conference brings together international thought leaders to reflect on the main challenges faced by central banks and macroeconomic policymakers. This conference looks at 4 key questions. First, we look at how major economies are likely to return inflation back to target and stay there, and the risks and issues involved with that process. Second, we will gain perspective on the impact of the global financial cycle on emerging markets. Third, we will advance a discussion on long-term risks and structural challenges, focusing on the impact of climate change adaptation and mitigation on economic growth. And finally, we will look more closely at how emerging markets can maintain a stable macroeconomic environment through better macroeconomic policy coordination, in part with reference to South Africa's experience.
Now I'll start with the outlook for prices. Our Business Inflation Expectations Survey is a monthly canvas of 200 U.S. companies across industries and firm sizes. In the latest BIE, fewer firms say that they plan to continue raising prices, and those that do plan to raise them say they'll do it by smaller amounts. Almost 3/4 of firms reported that they increased prices of their core products or services in the 12 months through May of 2023. And the average increase here was 7%. By contrast, for the year ahead, 57% told us they intend to raise their prices, and by an average of only 4%. Other surveys from a research collaboration with colleagues at the Cleveland Fed and New York Fed show similar projections of less severe price increases to come. And finally, feedback from field staff in our Regional Economic Information Network offers still more confirmation that peak pricing power has most likely passed. The anecdotes pointing to diminishing pricing power and perhaps moderate slowing in economic activity are supported by preliminary results from the most recent Atlanta Fed Survey of Business Uncertainty, or SBU. In the most recent survey, year-ahead nominal sales growth expectations slowed from 5% at the beginning of the year to 3%, which is well below the pre-pandemic average for expected sales growth in the SBU. Now, turning to labor markets, there appears to be a measured cooling afoot there as well. After the jobs report in May showed a 1-month surge in hiring, the June and July reports showed employment growth continuing to moderate, albeit at a slower pace. And I will also point out that for the first 6 months of this year, the United States Bureau of Labor Statistics revised payroll employment growth downward by an average of 40,000 jobs a month relative to the initial release. So the labor market was not running quite as hot as we had originally believed. And based on the BLS's preliminary benchmark estimate, it looks like employment growth in the first quarter of 2023 will be revised a bit lower still. Now, furthermore, the job market may be cooling even faster than the headline numbers suggest, as growth in total hours worked has slowed more than growth in unemployment, or growth in employment, because of recent increases in part-time work. Now let me say a word on wages. Now, economists are concerned about how much wage pressures are influencing inflation, especially in services prices. And to be sure, debate continues about whether wages are a lagging or a leading indicator of inflation. Now, I'm not going to settle that question today. But what I will say is that via the SBU, we detect signs of current and future wage growth moderating. For the 12 months starting in May of 2023, the SBU says employers aim to raise wages an average of 3.6%, which is down from last year's 5.2%. And here let me offer a little context. For much of the past couple of years, elevated inflation made real wage growth negative after positive growth just above 1% before COVID. Given that, I would expect nominal wage growth to exceed inflation for a time, as real wage levels revert to the pre-pandemic growth trend. And in fact, over the past 3 months, average hourly earnings pretty comfortably outpaced inflation, as the slide makes clear. So the upshot is wage growth is moving back toward normal, which over the long term typically means an equilibrium level roughly in line with productivity growth. As long as firms continue to signal a slowing trajectory on price growth, that is, that they're willing to absorb some margin contraction, then real wage growth should not put upward pressure on prices. Now, our conversations with business leaders confirm that scenario. They tell us that they're raising pay so their employees' wages catch up with past inflation, and they are not anticipating having to raise prices in the future to keep pace with the higher wages. And as I noted, our surveys and conversations make clear that employers plan to taper down those wage hikes to normal pre-pandemic levels in the coming years. So I'm not overly concerned that a period of moderate real wage growth will rekindle inflationary pressures. Now, I've cited evidence this morning that I believe represents a convincing case that the rate of inflation will continue declining toward our objective of 2%. Reductions in planned price increases, cooling in the labor market, and ultimately a measured tempering of economic activity that will bring supply and demand into closer alignment.
Remains too high, well above target, and there is no real room for complacency. Of course, we do draw some comfort from the recent decline in headline inflation, which is our targeted CPI measure, but there are also cases for caution. Core inflation in the UK, excluding food and energy, remains stubbornly high, and indicators of underlying or the more persistent components of inflation, the MPC has identified 3, wage growth, the tightness of the domestic labour market, and services price inflation. Those indicators of those 3 phenomena, they've developed less benignly of late. And given the lags in monetary policy transmission, the famous long and variable lags, it's that persistent component of inflation that we have to focus on, because it's that persistent component of inflation that will still be with us when the lags in policy transmission unwind. So over the last 2 years, year and a half, the MPC has done a lot. Bank rate has been raised by 5.25%. We've halted QE and started reducing the balance sheet, and we've changed our communication about monetary policy in significant ways. As a result, and given the lags in transmission, there's a lot of policy in the pipeline to come through. But at this stage, in my view, and I think consistent with remarks that Raphael just made, the key element is that we on the MPC need to see the job through and ensure a lasting and sustainable return of inflation to the 2% target. We certainly need to ensure that we do enough with policy to make that the case. There are risks on both sides. Now that policy is in restrictive territory, there is the possibility of doing too much and inflicting unnecessary damage on employment and growth. But at least in my personal view, at present, the emphasis is still on ensuring that we are, in the words of the MPC's last statement, sufficiently restrictive for sufficiently long to ensure that we have that lasting return to target.
So let me show quickly how inflation in the euro area and in the US look like. And in the case of the euro area, the last readings for HICP, harmonized index of consumer prices, is 5.3, and for core is 5.5, well above the 2% target, with core showing to be very sticky, albeit to be known to be a lagging indicator, if you want, of prices instead of a leading indicator for HICP. The last readings from yesterday for Germany are 6.4% for HICP, 5.4% to core, beating up essentially the forecast of the markets, and that might sort of let people think that there will be a further tightening in the euro area monetary policy. And against this background of of a high surge of inflation and stickiness, we know that the policy stance tightened. Let me apologize for the dates that are wrong on the first chart. My spreadsheet on my Mac suffers of some bug I couldn't fix. But as you can see, the policy stance moved with a delay, especially in the euro area, against the surge of inflation, and then shoot up. In the case of the euro area, the current deposit rate is 3.75% with a 425 basis point increase from negative territory after the pandemic. And there's also a shrinking of the balance sheet because the APP, the QE program for the euro area, and the long-term refinancing operations are coming to an end, and there is repayments coming through and the end of the reinvestment of the APP program.